Welcome back, traders. In this video, I'm going to be sharing with you possibly the most important tool that you can use in your trading right now. This tool completely changed the way that I was trading, and hopefully now that I'm sharing it with you, you'll be able to improve your trading as well. If you find any value in this video, make sure you smash that like button and subscribe to my channel so that you can be a part of this wonderful community of traders. And make sure you stick to the end of the video because not only am I going to explain this tool to you, I'm also going to show you my strategy for using this tool so that you can implement it into your trading strategy and become more of a profitable trader. So as you can see from the title of the video, the tool that we're actually going to be using is called the Fibonacci Retracement tool, or I call it Fibs for short. I'm not going to go into too much detail onto how exactly these levels of the fibs are created, but basically it was created by an Italian mathematician a long time ago who figured out this Fibonacci sequence, and basically if you divide those numbers around, you get these levels that I'm about to show you. Alright, so now we've got our chart open. I just clicked on my Fibonacci tool up in this top left over here, and I'm going to draw it out so that I can explain all the levels of the fib. Essentially, each level on the fib is an area where you would expect price to retrace, hence the tool being called a retracement tool. And retracement is just another word for pullback, so you'll often use this tool when price is in an uptrend or a downtrend. So the levels on the fib are the 23.6, the 38.2, the 50, the 61.8, the 78.6, and the 100 level. On some platforms, you'll see this as a 1 and a 0, and then on other platforms, you'll see it as like a 0% and 100%, so it might change depending on what platform you're using. Now, the 50% level and the 100% level aren't actual levels in the Fibonacci sequence. However, they're common areas where price can pull back to, so we also use it in the Fibonacci tool as well. So if you look at the fib tool that I just drew out, you might notice that I actually don't have the 23.6 level on my Fibonacci. And the reason for that is that I often don't see that level as a good place where price pulls back. You'll see it retrace lower to the 38.2, the 50, the 61.8, or the 78.6 a lot more. So I don't see it as a reliable place that you can take a trade off that area. And if you look at these yellow lines up here, these are basically the extensions or areas where you would look to take profit. So the negative 0.27 is an actual fib level where you would look to take profit. However, the 13.0 level isn't an actual fib level. It's just a personal number that I use since I was born on the 13th, and I sort of see it as a lucky number. I often find that price will eventually grind up to the 27.0 level, but when price comes up to the 13.0 level, you often capture the full impulse of the first move when the price makes its new high towards the uptrend, or the move down when it's on a downtrend. Now, just because I use this 13.0 level does not mean that you have to as well. If you see value in it, then you can use it if you want to, but that's just a personal level that I've been implementing a lot more. When drawing the fibs, there are 3 rules that you need to know in order to use this fib tool correctly. And I have these 3 drawings here that I'll use as an example to show you as I go through these rules. So the first rule is draw from swing low to swing high when price is in an uptrend. So you can see here that price is making higher highs and higher lows on an uptrend. So if you wanted to capture a move, you would draw from the swing low all the way up to the swing high, and you see that price pulls back off the 50, and then you'd hit your take profit near these golden areas. The second rule is draw from swing high to swing low when price is in a downtrend. So you can also use the Fibonacci tool to short a stock as well. So you'd start from the swing high up here and you draw it down to the swing low. And as you can see here, price also just happened to bounce off the 50 fib, and now price is heading towards your take profit. And the third rule, which is probably the most important rule that a lot of beginners mess up, is that you have to use the right time frames trend, which you see that here you have price moving higher and lower, but you see a small little hiccup in price. This would be like a lower time frame trending within the actual big move of the trend. You wouldn't want to draw from this level to this swing high. You want to capture the whole entire move of the trend. So I'm going to draw in my fib, and you'll realize that you don't want to do it from here to here. You'll notice that you do get a bounce. However, these are false signals and they can lead to errors in your trade. Instead, you want to drag it all the way from the actual swing low, and then you'll see that price instead bounces off the 50 and you're having the more correct take profits. All right, so now I'm going to go show you 2 examples using Apple and Euro USD to show you how you can implement the Fibonacci tool into your trading. So this is a 4-hour chart of Apple, and as you can see, it's making new highs and higher lows as well. So right now, let's say you wanted to enter in off this impulse of the trade right here. What you would do before you draw your fibs is first find your support and your resistance. This is how you can have multiple confluences when you enter a trade. So you'll see right here on this trend that price is pulling back and it made a new push higher. What you would want to look for is price to come back down to this level to make a new push to the upside. And as you can see, it actually did that. So if we were looking at the chart prior to this, let's say we drew in our support at this level right here, and now we can see price is beginning to pull back. So that's where we would go in and draw in our Fibonacci trading tool. And what you see right here is that you have the 38.2 level line up with the level of support, which gives you multiple confluences to enter your trade. So now I'm going to go into the lower time frame because we're using multiple time frame analysis, and you'll see how you could have entered at this level to capture this whole move. So I'm going to go down to our hourly chart because it's down by a factor of 4. So if you're trading off the 4 hour, you want to use your 1 hour to enter. And you can see here that on the 1 hour, it actually breaks a new low and starts to form a downtrend. However, it fails to make a new low. And what you see is a bullish engulfing candle. So you may say that you want to enter off that area. And what you'll do is you'll put your stop loss below the low or below whatever fib it bounced off of. And then you could go ahead and target either your 13.0 level, which would give you a 1-to-4 risk reward ratio, or you could go ahead and target all the way up to the 27.0 level, which would have given you a 1-to-5.6 risk reward. So you would really make 5 times what you risked on that trade. And as you can see, you could have also entered when price first touched down at this level down here. However, you want to make sure that price is holding that level and that you see buying pressure come in. So once you see this first green strong candle, you could have entered here, or you could have waited till price retraces a little bit more to try and test a new low and then hop in like I did show you in this trade right here. Because the last thing you want to do is enter at the 38.2 level and then price ends up retracing all the way to the 61.8, and you would have been right about the trade, but you would have entered a little bit too early. All right, and now this is a chart of Euro USD, and this is to show you how the fib can really work on any time frame. So that last trade that I showed you on Apple would have been more of like a swing play, but this was actually a trade that I was trying to take last night that would have been a scalp on Euro USD. All right, so prior to taking this trade, I would go and mark up all of my support and resistance on the higher time frames like the 4 hour, and then I would go down to the 1 hour to look for more plays, and you'll see that there's also a level of support / resistance sitting at this level right here. And now I'm going to go into replay mode to sort of show you what I was looking at last night before I took the trade. So it was actually at this area right here, right once the London session opened for me. So like I said, you first want to draw in your support and resistance. Since I'm going to be scalping on the 5-minute or 15-minute time frame, I also want to make sure that I have my hourly support and resistance drawn in. So I saw this as one level that I'd want to look at. And then I also thought that as a more recent structure, price might want to retest its previous swing high. So I also had this area as a level that I was also looking at. Now I know that this price action is really choppy, so it might be difficult to figure out where your swing high and swing low can be. But if you just realize that price is on an uptrend and it's making, right here, it's making new highs and then higher lows as well, you can sort of get an understanding of where price is heading. So I'm gonna get rid of this tool that was drawn super ugly, but here now I'm gonna go and draw in my Fibonacci. So this right here is the most recent swing low from this new high. So I'll draw it from this low up to this high. And what you'll see here is that we actually have the Fibonacci line up with both the 50 level right here, which is our level of support, and then also this 61.8. So ideally you would want to see price bounce at either one of these levels. More likely you'll see a lot more buying pressure come in at the 61.8. And now I'm on my 5-minute time frame. Usually when I trade using the hourly, you should go down to the 15-minute, but I use the 15-minute and the 5-minute like at the same time to determine whether or not I want to enter a trade. So if we were looking at price from here, we want to see a rejection and a bounce off either the 50 or the 61.8. So we see price pushing down. It just touched our 50 level, but you see that no buying pressure came in. You see price wick up, but you still see red candles coming after, so you wouldn't want to enter at that level. You want to at least wait until you see a green candle or some buying pressure at these levels. More often than not, when there's really strong buying pressure at these fib levels, you'll see price just get wicked up super quickly. So you have to be a little aggressive with your entries, but not too aggressive to where you overshoot and price just ends up stopping you out right away. So I'm gonna click play and price keeps pushing down. And right now, you see price coming into more buying pressure. However, it's a little choppy around this 50 level. I'm thinking that price might want to continue down lower to this 61.8. So I'll keep pressing play. And right there, you see price pushing down lower. And this is a really nice setup. I'm gonna click it over one more time so that you can see the next green candle. All right, and there's that green candle. And here's what we're looking at on our 5-minute. You see price pushing down, and then you go and look at your RSI and you see that price just made a lower low. However, on the RSI, we're beginning to see some bullish divergence off the 61.8 level. And then you see this nice wick candle here and a strong bullish candle after that. And that's all I need to enter a trade. So you can enter off this level right here, and you can place your stop loss below your fib that it bounced off of. I use my ATR to determine how deep I want to put my stop, but let's just say you put it around this level for roughly an 8.5 pip stop loss. And then for your targets, you can try targeting the first high, which would give you a 1 to 2.3 risk reward. You can then target the negative 0.13, which would give you almost a 1 to 3 risk reward. And then you can target the 27.0, which would give you a 3.67 times what you were risking. So on this trade that I was trying to take last night, I was trying to target the 13.0 level. And when I click play on this trade, you'll realize why I missed my entry, because it started flying right once the London markets opened. So here, right after where I would have wanted to enter, price just started pushing up. You see price come up and tag the 13.0 level and start pulling back. And that's what I was saying, that usually you'll see the price make a strong impulse move to the 13.0 level, and then you'll see it sort of chop up and slowly grind up to the 27.0. I like to get in and out of my trades after just one swing. And if I'm targeting the 13.0 level, I also captured a 1 to 3, which is good enough for me. And you already would have been in and out of the trade in less than 10 minutes, which was actually insane. I'm pretty mad that I missed my entry on that, but this makes for a really good example of how you can use your fib to implement it into your trading. All right, and that's all for the video. If you like this video, make sure you smash that like button and subscribe to see more content. And make sure you join the Discord link in my description. We just passed 500 members, and there's a lot of educational content in there that can help you improve as a trader. Thanks for watching.